So this could be an example of an ESOP fable. The moral of the story would be you should always talk to your retirement plan advisor late in the year. This actually happens quite frequently. We had a client recently who closed a big order out. He's an S corporation and closed a big order out late in the year, but he didn't actually receive payment that year. However, because of his accrual basis accounting, he had to declare that as income for the year. We get the call from the accountant later in about March or so, and because of this order, it actually increased his gross profit significantly, and they were looking for last-minute things that we could do. The only option that we had left at that point, because we hadn't established a retirement plan before the end of the year, was we could do a SEP IRA. Many people are allowed to do those. It's the only retirement plan that you can actually set up after the year has ended. Any other plan, you have to be proactive and set it up before 12/31. That one can be established up until tax filing deadline plus extension, which kind of worked in his situation because he didn't have the cash flow to actually fund a plan before that. He actually didn't have the account receivable until about March or so to begin with. So we set the retirement plan up, the SEP IRA. It worked fine. It could have, however, worked much better if he had had a conversation with us in late December. And the reason is, in an S corporation, you have, as an owner, you have W-2 wage. You also have a profit portion passed through on something called a K-1. The K-1 flows as ordinary income but not earned income onto your 1040. Well, the problem with that is we can only use the W-2 wage in an S corporation to skew the contribution for the business owner. So, in other words, we have to make a fair contribution in a SEP plan, the same percentage for all involved, unless we integrate with Social Security, and that's a whole nother story for another day. But that business owner only had about $90,000 of W-2 income. He had another $150,000 of profit based on that late year piece of business. His employees, on the other hand, as an aggregate, had close to $200,000 of income when you looked at all of them together. Well, we had to do the same percentage. So the example would be if we wanted to do a 10% profit share into the SEP, he would have received $9,000, but he would have had to put $20,000 in for his employees. A very simple step that we could have taken is if late in the year we were able to talk with him and his accountant, and he paid himself a bonus that would become W-2 wage, and it passed muster with his CPA that it was reasonable compensation. We have to make sure that hurdle is cleared. What that allows us to do is have more money on the W-2 side. So instead of having $90,000 of W-2 income, let's say he has $150,000 and his employees still have the $200,000. Now, if we make a 10% profit share, we can put $15,000 in for him. We only have to put $20,000 in for the employees. It skews the contribution. We can actually take his income, assuming that he has enough profit to do so. We can actually take his W-2 income in 2012 all the way up to $250,000. So the closer that we can get the owners in the highly compensated group, the closer that we can get them to the same amount of total W-2 wage that the employees have, the better a SEP plan will work. Now, with some proactive planning, we can do even better than that. But this is the last-ditch effort. So the moral of the story is, talk to your advisor in December if you think you're having a really good year. Don't wait until February or March, because many of the options that are sometimes simple, just how we categorize something, go away and we can no longer use them.